All right, Justin, we're back. We're going to dig more into our Pursuing a Better Investment Experience series. Hopefully this is timely given the market environment right now. If you're listening kind of close to the recording date here, we've definitely had some volatility. We got interest rates spiking, a lot going on. So I think it's a good time to dig in and really talk about how markets work. We hit on really embracing market pricing last week. And to follow up on that, we're going to jump into the topic of resisting chasing past performance because, the evidence just doesn't support it, to be very blunt. So I'd love for you to set the stage here a little bit, Justin. When you're looking to invest, it seems natural. I know when I got into the industry, this was definitely something that seemed natural to me. Let's go find the best manager. Somebody has to have skill out there. And in fact, a lot of people probably have to have skill out there to outperform on a consistent basis. And I'll kind of, cut to the punchline, but it's not true. It took me a little while to figure that out, but I'd love for you to just touch on it. Your experience, obviously, being a CFA, you've studied this stuff pretty in depth.
Yeah, sure. And it is really natural. I mean, when you're setting out to do anything, you want to do it the best way. You want to really seek to be the best you can possibly be in any walk of life or any pursuit, especially with the clientele that we deal with and those that we just interact on a daily basis. So I want to just start there. It's okay, right? I guess giving that pat on the shoulder, it's okay. But what I think is often overmissed, and unfortunately what the industry does is doesn't take it a step further, because it's easy to stop and just think or present something as being the best, right? Without truly digging underneath the hood or going underneath the hood. And that's what the critical step or process is that we need to take, and that we truly believe in the way in which we think about the world. So getting back to kind of what we're talking about here is how do we apply that process? And that is to look at the data. It ties directly into what we discussed last week around markets being efficient. And essentially what that means is when it's applied to this conversation is that it's incredibly difficult to outperform. And the data supports that. So the analysis, the second question is, after you say, okay, I want to outperform, let's go find the best fund manager. Well, you can find somebody who outperformed the market as a whole last year. Then the next question becomes, well, is that manager likely to outperform this year? And what about next year? And how persistent is that outperformance? Is there skill? Is there evidence of skill being involved with that? And you jump to the conclusion. And the answer is that the data just really doesn't support that. And you, generally speaking, give up actual rates of return relative to the market by chasing this outperformance, which like I'm saying, that you're giving up performance. So by chasing outperformance, you're generally underperforming.
And I think, part of the problem is our industry, and specifically you go to the big broker houses, the Merrill Lynch's, Morgan Stanley's, Goldman Sachs, et cetera, right? They've built their entire value proposition on this notion that they're going to allocate your money better than somebody else, right? And so I think that's where we end up leading here. They can't give advice on really anything else. They're too big of institutions. The risk is far too high for the equity owners, the stockholders of those companies. And so they have to turn to, hey, the only value I can really add is outperformance of picking different funds, et cetera. We'll get into individual stocks later on. But when we really go back to the data, like you said, I mean, there's a study in our industry, the SPIVA, that really goes through this data. And I thought this was fascinating. And I think you could look at this one of two ways. So I'd love for us to unpack it. But when you look at US large cap equity, so large company managers in the US versus the S&P 500, which again, large, but that's the index. Over 1 year, 85% underperform. Over 3 years, 68%. 5 years, 74%, 10 years, 83%. The odds are overwhelmingly against you. At least if you go to the blackjack table, you got what, a 49% chance of winning or something like that. But, I have heard the argument on the other side. And quite frankly, the person that we came up under, I think, believes this and taught this, but let's go find the 15%. Let's go find those people. And I think, the difficulty really comes, like you're talking about, is if you can't consistently figure out the criteria or the characteristics of that 15%, that 15% changes all the time, year in and year out, it's changing. It just makes it really difficult, right? So, really looking at these different stats, I'd love for you to unpack even a little bit more when we're going after selecting funds. Are there other criteria besides performance that you can maybe take a look at?
Yeah, totally. So this isn't a, hey, set it and forget it, just go buy a Vanguard fund. Those are great solutions. Right. And it's also good to take a quick step back while I'm saying this and say the market actually gives you a good rate of return. So if you're getting that rate of return, it's not terrible. I mean,
it's a great wealth builder.
Yeah, the capital markets have done an incredible job building wealth over the long term, right? And I think it's also important to insert here that we're talking public markets again, not private markets. We'll probably comment on comparing these two things in a second, but not thinking purely as an index play. What we then do is go a little bit deeper within an index type strategy. Again, that's a great place to start. It's low cost. It's generally tax efficient, which we love. But what you can do is you can be thoughtful around tracking the market. So indexes and benchmarks have something called a reconstitution. So sometime throughout the year, they change the players that are within their index, right? Recently, a big example of that was Tesla coming into the S&P 500, replacing some other stock I can't remember off the top of my head right now. And the market can get ahead of that. And there's some inefficiencies in that process. But if you're just purely following an index, you have to play along with that. The date that it gets added to the index, you're buying it. And there's some interesting market dynamics that come along with that. And so being aware of that and avoiding the pitfalls makes a lot of sense. Also, just thinking about parts of the market. So you can dissect the market. You mentioned large companies. There are also small companies in the market. There are growth companies. So think more of the big high flyer names over the last couple of years. Those are more growth oriented companies versus value oriented companies. Those would be the opposite. If you look over long periods of time, value companies, smaller companies outperform. So you take a broad-based index approach as a starting point and then just be thoughtful around it and not just follow it in lockstep and be subject to the inefficiencies that exist there. But it's a great starting point. Introduce these other little factors and trading methodologies that actually start to add value and are a proven way. The evidence is really strong that these add value, add outperformance over the long term.
And I think that's a fascinating point. And the one thing even about those funds, right, is that they don't year in and year out outperform, right? But there is a persistence over a long period of time that they are showing up consistently if you're a long-term investor with outperformance, and that's where you want to be. And unfortunately, actively managed funds just don't perform that way. They don't have that same persistence. Again, Spiva puts out a persistence report, and the data is just overwhelming that it doesn't exist in those active funds. And I'd love to take a quick tangent because we're talking a lot about the mutual fund world. A lot of people trust a single or two or three financial advisors, which is scary, quite frankly, especially at some of these big brokerage houses. Yeah, they've got quote unquote all the research, etc. But if the big fund managers can't outperform, what in the world are we thinking that some of these financial advisors can pick stocks and outperform? Because that's essentially what a fund manager is doing. So you're going from, for those athletes that are listening, you're going from the NFL, Major League Baseball to, high school baseball when you've got these financial advisors picking stocks. So it's a completely different game. And I think you just get yourself into a lot of of trouble there. So it goes both ways. These are for professional fund managers that are actively picking, or, the local financial advisor that's, just a broker and has the crystal ball. Neither one of them, quite frankly, have the ability or the skill to outperform. So you kind of want to steer clear.
Well, and let's put some numbers around this persistence topic as well. We've mentioned it. We mentioned there is no evidence of it, but the numbers are actually really, really, really bad. It's not even like maybe you could tip the scale in favor. But just quickly, and I'm going to take this slowly, but just so it's really impactful and we make sure we get the point across. But a recent study looked at rolling 5-year periods. So what that means is you have a starting month, you look 60 months backwards. That's a 5-year period, right? 60 divided by 12. Yeah. So there's a 5-year period. You go forward 1 month, that's another 60-year period. So you actually get more 5-year periods, even though that's just a single 10-year period of time. That's what a rolling period analysis does. And looked at the overall performance of mutual funds, took those that were in the top 25% of performance over each one of those unique 5-year periods of time, and then looked, hey, 5 years in the future, are those that were in that top 25%, are they still in the top 25%? And what shows up is that only 21% of those that were in the top are still in the top 5 years later. So not only is it a small select few that is in the top 25% to begin with, but less than a quarter of those actually continue to persist from an outperformance standpoint into the future. So it's incredibly difficult to identify who's going to outperform, what are the characteristics and whatnot.
To be clear, that's like 7% of funds exactly, when you do the math. I mean, it's pretty incredible.
20% of 25%.
Well, I think we beat this dead horse. Hopefully this is pretty obvious to everybody. It certainly was eye-opening for me at one point in my career when you really took a look at it and you started to figure out what you actually can control for a good investment experience. And, the other big thing that I think was a little bit tough or unintuitive to wrap your head around is this whole concept that we're going to hit on next week. And that's really trying to not outguess the market. So let's not try to figure out when to get in, when to get out. We all know that's really difficult to do, or at least us within the industry that dig into the data know it's tough to do. So we're going to unpack that next week. We'll probably have some more good zingers there, but we appreciate your attention this week as always. Before we close out, as you guys know, you can text me. We love to hear your questions on this. 602-704-5574. Just shoot AWM Insights in that text. Throw your question to us. We'd love to answer it next week. And until next time, own your wealth, make an impact, and always be a pro.
The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.